So I got a comment a little while ago on the channel asking me to talk about ETFs with downside protection. And if we come to my portfolio on my dividend side, I have JEPI and DIVO. These are my two dividend ETFs, and they both in a way offer downside protection or downside mitigation. Now, that's not the main reason why I invest in these, but it is a nice added bonus and a major feature of these ETFs. So in this video, I want to take a bit of a dive into downside protection ETFs because they come in lots of different flavors. To get started, these are 6 common portfolio protection strategies. The first one is just simple diversification, non-correlated assets. So that means if one asset goes up, the other tends to go down, offsetting each other. Put options, stop losses, dividends is a downside protection method because the dividends are usually pretty stable even if the stock price goes down, giving you kind of a base of return. Principal protection notes, and well, I guess that's it. So I went ahead and took the liberty of creating 2 groups to identify different kinds of ETFs with downside protection. Now, there's lots of niche financial products that offer downside protection, but these are 2 major categories. And the first one is just low volatility. So these are ETFs that handpick individual stocks for their low beta or low volatility. I'll leave this link down below. This is a list of low volatility ETFs, and the most popular one is USMV. We also have SPHD just a little bit lower down on the list, and this is a high dividend, low volatility equity ETF. So let's quickly use both of these as an example of what these funds are all about. So USMV offers a minimum volatility portfolio of US stocks. The fund's index uses an optimization algorithm to build a minimum variance portfolio, one that considers the correlation between stocks rather than simply holding a basket of low volatility stocks. If we come back to this article, that is one of the methods here, not having correlated stocks, as well as diversification. So this ETF is hitting on a few notes. And if we scroll down and look at the performance of the ETF, it's actually one of the better low volatility funds out there. It's appreciated over 20% in the past 12 months, which is really good for a low volatility ETF because volatility is in both directions, up and down, but yet this still managed to go up 21%. In fact, let's add in SPY, just so we have a point of comparison. And look at that, it's not too far behind. Let's zoom out a little bit to get a better perspective. And it's definitely a competitive fund, although in terms of low volatility, I'm not sure if it really accomplishes that. Now, in my opinion, another low volatility, in quotation mark, ETF that is not low volatility at all is SPHD. As we saw in the list a little while ago, it is one of the most popular low volatility ETFs, and this is how it works. So SPHD cherry picks the US equity market rather than delivering the whole basket. It includes the 50 least volatile names chosen from a short list of the S&P 500's 75 highest dividend yielding securities. The fund then weighs selected stocks based on a trailing 12 months dividend yield with sector weights capped at 25%. So that's the basics on how this fund operates and its selection methodology, and it sounds good on the surface, but the reality is a little bit different. And in the past 12 months, it actually has done decent, but when we zoom out, that is when the story changes completely. So if low volatility means not going up much, then this ETF definitely accomplishes that goal. But in terms of volatility to the downside, it definitely has that. So low volatility ETFs are just one method of having downside protection in your portfolio. The next major group is options. So ETFs that implement some kind of wide variety of option strategies. And I have a small group here of different ETFs that offer completely different strategies using options to try to deliver some kind of downside protection. And let's start with this first one. This is a Black Swan ETF, ticker SWAN. And keep in mind, when it comes to options, which all these ETFs utilize, there's 1,000 different strategies and financial derivatives that they can use, so they're pretty interesting. So this one, the Black Swan ETF, seeks investment results that correspond to the S Network Black Swan Core Index. The index investment strategy seeks uncapped exposure to the S&P 500 while buffering against the possibility of significant losses. Approximately 90% of the Black Swan ETF will be invested in US Treasury securities, while approximately 10% will be invested in SPY leap options in the form of in-the-money calls. And according to them, these are the three main advantages. So it participates in the S&P 500 returns while seeking to protect against significant losses. I mean, that's kind of the whole thing with all of these funds. They try to have as much upside participation as possible while capping downside. And these are all just the various methods in which they try to achieve that. I actually want to come down and look at the holdings because, as mentioned, it's 90% 10-year US Treasury notes, with 10% of the holdings being these call options on the S&P 500. So definitely an interesting strategy. This is how it's done over the past 12 months, and this is how it looks against the S&P 500. Something to note, let's zoom in a little bit more, is that during the coronavirus crash, it kind of did its job. It didn't really go down, and of course, it doesn't have all the upside of the S&P 500. But I gotta say, my scientific opinion is the line is definitely going up and to the right, and that's usually a good sign. Now, the next one is DIVO. This is actually by the same company, and I talked about it a lot on my channel previously, so I'm not going to take a deep dive into it, but the gist of it is that this is mostly just dividend-paying companies with some covered calls on top of it to deliver more income. And as we saw in this article, dividends are a form of downside protection because you always have a base level of return. If a dividend is 3%, then you're most likely going to have a 3% return that year at least. Because in a hypothetical crash, say the market goes down 10%, but you collect a 3% dividend, you subtract that from the 10% loss, meaning that you only lost 7%. So in a nutshell, that's what DIVO does, along with extra income from the covered call. So it's kind of a super dividend ETF. Now this next one is a completely different strategy. You can see that in the long run, it's down 74%. But this one, PSQ, uses swaps to be the inverse of the QQQ. In fact, if we put this line against the QQQ, you're going to notice something pretty interesting. It is the exact inverse. Now, do I think this is a great long-term holding? Absolutely not. You don't want to bet against QQQ, one of the best performing ETFs of the past decade. But one of the downside protection measures is non-correlated assets. So if you hold the QQQ and you're afraid of the volatility, you could open up a small position in PSQ, and this will help to offset some of the price movements, but it will hold you back most of the time. The next one on the list is NUSI. This definitely has to be one of my favorite ETFs for downside protection. The price appreciation isn't great. It's not designed for that. It's designed to move sideways and give you a lot of income. It has over a 7% dividend yield. And the way NUSI operates is super simple. I'll leave my video on it linked down below, but they have a covered call similar to DIVO, and this helps to give you that high dividend yield, but it's also what caps your upside potential. But they use some of that covered call income to then buy put options to protect you from the downside. And what this all means is that NUSI operates between this narrow range. The covered calls and the protective puts, I believe, are like 10 to 15% out of the money. So that's how much room it has to move up and down within 1 month, while giving you a lot of income from the covered calls. And that's why the price history looks like this. It just moves sideways, and if it goes down or up too much, it gets capped because of the calls or the puts. So it's definitely not going to make you wealthy, but if you already have a lot of wealth, this could be a great way to go to protect some of it and earn some income. And that leaves us with JEPI. This is one of my favorite ETFs because it has great cash flow. They use ELNs, which are essentially just call options similar to what NUSI uses and even DIVO up here. So that generates you the high yield, but they also have great price appreciation. And with these ETFs that offer downside protection and income, usually the main trade-off is the lack of price appreciation, because downside protection essentially costs a lot of money if you want to look at it that way. But JEPI seems to be defying the odds. Maybe the ELN structure of the call options has something to do with it, but so far, JEPI has been performing very nicely. If we come back to my portfolio, I hold both JEPI and DIVO because they have great payouts using covered calls, and they have lower volatility, giving me that downside protection in two forms: lower volatility, but the major one is through higher dividend payouts, which gives me that base level of return. If I missed some niche specialty downside protection ETF, let us know in the comments down below. But this is kind of how I see it. There's two groups. The first one is just low volatility equity ETFs that don't have many correlated assets. And then the second group is a pretty diverse one that use options. And they can do this in a magnitude of different styles and strategies, trying to give you some downside protection. If you guys are still watching and enjoy, definitely give the video a like, subscribe to the channel, all that YouTube stuff. And I'll see you in the next one.